kick us off here, thanks for coming to another one of our webinar series. Today we have Jeff Klein joining us, which I'm pretty excited about, here to talk about derivatives and capital markets. And so Jeff leads up the JLL Capital Markets for America, their derivatives division. He used to be before that at Kensington Capital, if you're familiar with them, or maybe you've transacted with them in the past. But Kensington Capital Advisors and Frame Financial Systems rolled into JLL. So we worked with Jeff now on a few deals to buy SOFR caps, and we thought it'd be really helpful to have him come on to both educate us, but also educate our investors about how we hedge against what we're seeing right now in the capital markets with interest rates increasing, and trying to figure out how we can make sure we're not getting caught in the upside. So Jeff has been in the business for about 30 years and has a depth of knowledge. And so I'll turn it over to him, but he's going to talk a little bit about just kind of macroeconomic factors that play into derivatives. And then he's going to walk us through how caps are priced, and then walk into an example for how we actually execute an interest rate cap on our loans. So we'll have about a 30-minute presentation, maybe 35. He's got a lot of good knowledge here to share with us, and then we'll open it up for Q&A. So if you have questions, please put them into the chat. We got a few submitted prior to the webinar starting, so we'll ask those as well. But if you have questions while Jeff is talking, please just put them into the chat, and we'll get them at the end. And then we'll also be recording this, so if you want to share it with others, we'll have it in about a week for you to share via YouTube. So thanks for joining, Jeff. I'll turn it over to you.
Thank you, Nate. Thank you, everybody, for joining. I'm going to share my screen, and we'll get started with the material. So as Nate mentioned, we're really going to focus on two things with this deck. We're going to start with volatility and really get into the economic factors that are driving a lot of the volatility. And then we're going to focus then on SOFR and the market's forward expectations on SOFR. And then we'll get into hedging using those SOFR curves. So we're going to start with the Fed. So this graph, if we just look at the right-hand side, what we're showing with these bars that go down, the bars are the probability, when I did this deck last week, of an anticipated rate cut by the Fed, a 25 basis point rate cut at the remaining meetings. So we have this June 12th. You can see it's 0 because that meeting is now in our rear view mirror. And when I did this, there was a 2.5% probability implied by the market for the Fed to cut 25 bips at that July 31st meeting. And then you can see we've got 3 more meetings for this year, 4 sort of on the slate for this graph. And you can see the increasing probabilities that are applied. The green diamonds are where we were a month ago. So not as much of a movement in the front, a little bit more of an anticipated increase in probability for a rate cut as we move out towards the end of the year. And then every quarter on a March, June, September, December cycle, the Fed does update something that's called the dot plot, which we'll get into. And you can see from the red diamond that that is approximately where the Fed would imply the sort of like a probability of a cut from their point of view. So there's a difference between what the market is implying and what the Fed is communicating, and that's going to be a theme throughout this deck. But what has dramatically changed, and it's not in this graph, if you would have looked at this graph in January of this year, you would have seen that the market was implying over 6 cuts before the end of the year, which was very significant. A significant amount of that anticipated Fed activity for cuts has been removed. So let's talk about why it's been removed and why it's leading to volatility. So this particular slide focuses on 2 economic numbers that get reported each month. The left one is non-farm payroll, and the right one is the unemployment rate. They're actually released at the same time and on the same day. It's the first Friday of each month. and it's coming from the same government entity that handles the statistic, which is the Bureau of Labor Statistics, the BLS. And what we're going to break down on this graph to the left is we're going to look at the bars. The bars are the differential in percentage terms between what was estimated by approximately 50 economists each month before this data is released, and the amount of the report. So let's look at September of 23. It's a tall bar. It's almost 100%. The example of what this would be is, let's say that economists anticipated prior to this Friday release that 200,000 jobs were added that were non-farm related the prior month, and the report actually comes out with 400,000. So that's an example of where you would see the bar being a positive bar and it goes up 100%. If it's a bar below the line, it means that it was a miss, that the estimate from economists was for a certain number of jobs being added. We'll use my 200,000 example again, and let's say it comes in at 180 or 160. That would be a miss to the downside. The green triangles are the amount of movement immediately after the number, the economic report, is released in basis points for the 10-year Treasury. So what's happening is you're seeing that the moment that these economic numbers come out, especially when they are misses where the estimate was low to the actual report, we're seeing very large and almost instantaneous movements in treasuries. It's averaging around just under 10 basis points, but you can see we have a number of prints. We have a 14, we have a 15. And the other thing to note is we have these ups and we have these downs. We're missing to the high side big. We're also missing to the low side as well. So it's tough for investors, market participants, to get a foothold on themes as we're going through this. Why did I start with employment first? The Federal Reserve, which is the U.S. central bank, which was a creation of Congress, it has a dual mandate. And it's actually a really simple mandate, even though what they do overlay is pretty complex. It is to have control on price control in the country for goods and services. That's inflation. So they're expected to help to control inflation and protect jobs. That's it. So jobs and prices. So we're starting with one of their mandates. We're starting with jobs. If we move to the graph to the right, now we're looking at the same sort of number of jobs that were added in that month. So you can see sort of the up and down. This is the actual number of jobs. Remember, the graph to the left is showing in percentage terms how much the report missed from estimates. And then the tan line is the unemployment rate. And the theme is we're starting to have an increase in unemployment. So as the market's trying to address this, it factors into the very first slide where people are trying to anticipate, when is the Fed going to cut? How many times is it going to cut? What's the total magnitude of the cuts? Because that information finds its way into the mathematics associated with where the market trades, not only SOFR today, but the where you could lock in SOFR for various times in the future. I'll call that the SOFR forward curve. So before we move to the next slide, one takeaway: jobs are one of the two mandates for the Fed. We have a lot of volatility in the information related to jobs, and that volatility is finding its way into the interest rate market for volatility for current rates as well as forward rates. The second mandate we said was inflation, and there's a difference between year over year and month over month. So inflation peaked in the U.S. around the summer of 22. So we had all of 2021 coming out of the pandemic, where we went from deflation. So deflation is actually prices dropping, to inflation, which is prices increasing, to the peak of inflation, which was around 9% in the summer of 2022, which, if you remember back to the articles that were coming out, that was revisiting a 40-year high It was revisiting the very, very early 80s, where if you're old enough, you then reminisce about how we had 18% interest rates, and people would talk about how high their mortgage rates were, and gas prices went up. So we were sort of revisiting that period of time where we had a significant peak in inflation. But as the changes in monetary policy from the Fed, because if you recall, the Fed's been increasing interest rates to deal with that. And as that started to take hold, we then had a third word. So we have deflation, which is prices going down, inflation, which is prices going up. Disinflation is the rate of inflation, the rate of prices going up, falling. So if you measure it year over year, we were going from a 9 down to an 8, 7, 6, 5, 4. And then as we got to 3, we start to level off. And you can see even going into this year, you can kind of see that green line starting to level rapidly. And then depending upon which inflation report you look at, this is CPI, the green is core PCE. So these are different baskets. What I want you to look at is if you look at the CPI, we actually went from disinflation back to inflation again. Notice how we had this uptick that started very, very late in the fourth quarter and into the first quarter of 24. And what that did is the market now started reacting to that. This was some of the economic information that was leading to the 6 expected cuts by the Fed in 24, rapidly dropping to less than 1 only around a month ago. And now we're at around 2. So the market is trying to hyper-focus on the 2 mandates that the Fed has, because the belief is the Fed is going to look at the overall economy with respect to those 2 mandates for its timing on cuts to the Fed funds rate, which is the rate that they control, as well as other policy that the Fed can implement. If you move to the month to month, so now what we're doing is we're saying, well, from the last month to this month, is inflation up, is inflation down? You can see month to month, we have even more variability. And the Federal Reserve has identified a target for inflation year over year of 2. And it's sort of like that last mile getting from 3 to 2 has definitely been a struggle for the last 6 months. So that's why we continue to see a significant amount of volatility as we get conflicting data. Now we're going to step away from jobs, we're going to step away from inflation, and we're going to take a really big picture look. So now we're looking going back to the summer of 2019. So if you look at the purple line, that is SOFR. You can also think about that as Fed funds. They're very, very similar. And you notice that when we get to where the pandemic was, we drop to 0 and we stay at 0 for a while. So the Federal Reserve did communicate to the market that they did not have plans to have a negative interest rate policy. You might recall, especially in Euroland as an example, interest rates went negative for quite a period of time. That was a approach that the Federal Reserve has never adopted thus far. There's been talk of it from time to time, but thus far the Fed has never had a negative interest rate policy, but they did have a 0 interest rate policy. So you see how long we were at 0. And then if you recall, I said that as 2021 started, we started seeing inflation in the system. So you can look at the halfway point on this graph between June of 20 and June of 21. So that would be like sort of the January of 21. That's when inflation started to pick up. We went from deflation to inflation. Notice how long the purple went at 0. This was the marketplace. This was what was feeding articles about how people were saying that the Fed was late to start increasing interest rates. The Fed was communicating that they thought that the inflation that was being observed was transitory in nature. It was related to shocks to supply and shocks to demand, and the process by which you take raw goods and get them to be marketable products, as well as disruptions for service, because people might have to work from home. So In reality, the inflation probably wasn't transitory. And if that's the case, then the Fed probably was late with addressing monetary policy, because you can see when it started to step up. And that was in March of 2022. And this ended up being one of the more dramatic periods of Fed activity with changes to their monetary policy, how they were increasing rates, how quickly they increased them, and by how much they increased them. And then we've now been steady for quite a while. And this is where the transition is most likely going to be. If you ask me personally, I put a 0% probability that there's going to be a Fed increase from here. It's really just waiting for how long do we go sideways before the Fed starts to decrease. And back to volatility, there are a lot of different views on that. And because there are a significant number of views, you have competing factors, which is sort of a recipe for volatility. So I think this graph does a really good job of being able to show you with the purple short-term rates. The final thing before we leave this graph is the darker blue line is just the 5-year SOFR swap rate. You can almost think about it like the 5-year treasury. This line is maybe like 22 or 23 bips below where the 5-year treasury would be at. So it's pretty much a proxy. And then the gray shading is the difference between a short-term rate and a long-term rate. So what I want you to focus on is focus at the point in the middle between June of 22 and June of 23, where the purple line starts to go above the blue line. That is referred to as an inversion in the yield curve. So that's where a long-term rate, like a 5-year rate, is actually lower than a short-term rate, like a daily rate for SOFR. And we continue to be in an inversion where longer-term rates are actually lower than short-term rates. Okay, I'm going to switch the order on these two slides for a second. And now we're going to start talking more about the Fed and its dot plot and how the market digests information about the dot plot and the forward curve for SOFR. So one thing that I'm going to change with respect to this dot plot story, technically we should be talking about the federal funds rate. I mentioned before, you can kind of think about, to make things easier, when we talk about the SOFR rate, let's just say that that's the same as Fed funds. I think it makes the discussion a lot easier, and it's really not that far off. But technically, the story for the dot plot is you have 19 Fed members. They're not all voting members, but you have 19 Fed members, and each Fed member is handed 4 dots. And what they're asked to do is they're asked to place the dots on where they see SOFR at the end of, and then look at the bottom of the graph, 2024, 5, 6, and then long term. And we don't know whose dot is whose. Like, for example, if you look at 2025, you see a noticeable dispersion. There's more dispersion than in 24. And look at this dot that's up there at almost 550. I'd love to know who that Fed member is, but we don't know. All we know is we can see the dispersion. And I don't believe that the Fed itself does what I'm about to tell you next, but it's a human trait, right? If you're going to give somebody a dispersion of 19 dots, so let's focus on 2024, somebody who likes math is going to come in and say, well, what's the median of those dots? So that's that black diamond is the median. It's the way of sort of communicating. This is what the overall group of the Fed members think, if you believe in, the median for this case. And then to take that one step further, if you're going to have a graph like this and you're going to now have the medians as the black diamonds, somebody's going to draw a line through it. So that's what that blue line is. And what people tend to do is they say, well, this is the dot plot. So the Fed does refer to this as the dot plot, and they do update this on a quarterly cadence, typically, like I mentioned to you before, March, June, September, December. So on the left, you can see what the result of a December 2023 dots are. You can see that somebody put the medians in there. You can see that somebody drew the line through it. And that's kind of the path that people are looking at for how is SOFR going to drop from 532, where it is today, to something a little bit above 450, where it is at the end of 2024, and then a little bit above 350 by the end of 2025, if you follow this December dot plot. The final line is the SOFR forward curve. So this is a completely separate market. This is not 19 members of the Fed with dots. This is a multi-trillion-dollar market, and it trades the forward settlement for SOFR in the future, no differently than you might be familiar with orange juice futures can trade, or gold futures can trade, or oil futures can trade. These are commodities, and interest rates are just a commodity like those. And there's a market where there's a supply and a demand, where people will go long or short the futures contract. So you can think of the SOFR forward line as where the supply and demand equilibrium is for SOFR resets as you move through time. So you can see this sort of similar inversion, right? Rates are going down before they start to kind of stabilize and gently go back up. And you can see the difference between the forward curve and the Fed line. You can see how in December of 23, the forward market was more aggressive than the Fed. The forward market was showing a greater amount of cuts until it crossed halfway through 2025-26. And then now it flipped, and the Fed was more aggressive with cuts in the future than the forward. Finally, before we move over to this June 24, the most recent dot plot that came out, it's important to keep in mind that that blue line only changes quarterly, but the SOFR forward curve is changing every second. It's constantly moving around the blue line. So when we took a snapshot in this last June 12th meeting, because the Fed did release its dots, I found it very interesting, and so did many other market participants. First, look at the dispersion. So not only did the dots generally go up for where the members were expecting SOFR to be, where they put their dots for the end of this year, so it's a tighter dispersion, but it's also higher. And the median was higher. And the median was higher for 24, the median was higher for 25, it was higher for 26, and it was almost the same, a little bit higher for the long term. So why is that the case? Well, remember, we talked about jobs and we talked about inflation. So this is the result of what happens when we start to see the two Fed mandates that are put in question, jobs and inflation. If jobs start to struggle, if we see unemployment continue to go up, so at the last unemployment report, we went into the 4% range for the first time in quite a while. So if you start to see things break down in jobs, the way that the Fed is going to address that is by dropping rates. So think about it like reducing SOFR. And if inflation continues to pick up, the way that the Fed will deal with that is by sitting on its hands. That's what people mean when they say higher for longer. The Fed has made rates higher, they're going to keep them there longer. Those are the two basic themes. So if you see inflation continue to come down, and we have the Fed's most preferred inflation basket, its most preferred measure is going to come out this Friday, I believe. It's called the PCE. If you see inflation improve and jobs break down, that's just going to cause that SOFR forward line now in the June to rapidly go below that blue line, because that blue line will not reset again until September. That's why I wanted to switch the order of these slides, because now I've done this for you. I've made it a little bit simpler with the lines. I got rid of the long-term one. I've got a 2023 in here because each of these are snapshots of what was it on December 2022? What was it on March of 2023, and then June of 23, and then September of 23, and then December of 23. Notice how it changes. The forward curve relative to the Fed is constantly moving. So the theme that we have for people as we now start to transition into hedging is no one has a crystal ball. When we go back to the beginning of this year and there were 6 Fed cuts built into the forward curve, that there's no guarantee you're going to get those cuts. In fact, many of them have now been pulled out. It's the forward curve that drives hedge pricing. It's this tan line for SOFR forward. It is not the blue line. The blue line is the Fed. The tan line is where pricing for derivatives comes from. So if the market is going to deliver you a forward curve that has 6 Fed cuts built into it that might never happen, that's like a blue light special going on for interest rate hedges. And we saw a significant amount of activity for people who were either observing that or We're fortunate enough to just be in the market when that was occurring. But we do track this. There's no special algorithm for this. There's nothing more of a takeaway. It tends to be a very visual takeaway. I believe that people might try to come up with algorithms on this, but obviously if they could come up with an algorithm that was even right 51% of the time, they would be wealthier than Elon Musk. So let's transition into hedging. So this graph in the lower left, all it's really doing is we're showing you the actual path of SOFR as we move from January of 23 to February 24. And then we're showing you at very specific times what was the forward curve on certain dates. So let's take this blue, the light blue dotted line. On January of 2023, if you overlaid the forward going out in time, you could see that the forward picked up a little bit of the increase in SOFR from January to maybe May of 23, and then it started to break down. That's where you could see it starts going sideways, and then you start seeing rate cuts being built in, and it missed all of the increase from May of 23 to February of 24. So forward curve was wrong, letting you in on information that I hope you already know. The forward curve is almost always wrong. So be careful when you're loading forward curves into real estate models. If you just load a forward curve into a real estate model and you're not loading in the fact that the forward curve can be wrong, so you need to probably load in some standard deviation there too, then you're just setting yourself up to have cash flows that create conclusions for either holding real estate or selling real estate or buying real estate, and it's giving you information that's not as helpful as it could be. So it's important to incorporate some form of error, some form of standard deviation, the way that the option market, which is what interest rate caps and interest rate floors are, referred to it as volatility. And you can continue this theme. So now if we go out to March of 23, that forward curve only addressed things accurately for about 2 months, and then it rapidly broke down. And then you can see if you go to the July of 23, that's been the closest to kind of pick up the path thus far. I think what you'd see though is if we carried it out farther than Feb of 24, it would start to underperform. You'd start to see it go below where actual SOFR has been. But it's these forward curves that help us price derivatives. And so that's why early in 2023, like if you, like let's say in March of 23, if you look at that tan dotted line that really, really missed the mark, but that would have produced pretty low cap prices. So here on the right table, we just have a standardized structure. We said, what if we priced $100 million cap, and it was a 3% strike, and the blue is just a 1-year cap on 100 million at a 3%. The tan is a 2-year. And you can see the price is changing as the forward curve is adjusting. And, the theme, as you can see, as we go from these dotted lines in time, tan to light blue to purple to darker blue, the theme is higher and higher forwards. And now look over to your other graph and look at your cap prices, higher and higher cap prices. So sometimes we have the ability to talk with people and tell them, this is how much of a change in the forwards we have. This is how this relates to the Fed, if you're looking at the dot plot. If you want to talk about timing related to your interest rate caps, this is one of the ways that we address that. And you can see on this table, we are applying, standard deviation. We're applying a certain amount of error to the discussion. But there is no such thing as what is an optimal time to buy, what is an optimal cap rate, what is an optimal cap term. That gets back into, if anybody had that information, they would be able to make unlimited money. So now we're going to talk about hedging, and we're going to put some of these concepts together. So let's get oriented to this particular table. The first thing I want you to find is the darker blue dotted line. So that's the current forward curve when I did this graph last week. Notice how on the left, it goes from 532. So you don't see 532, but you can see the 5% line. So that very left part is 532. And you can see it go down to a little bit above 3.5% by the time we get 3 years out. So when I took this snapshot of the forward curve, this was the path. And this dark blue dotted line does get loaded into an option pricing model when you're looking to calculate the price of an interest rate cap. But we talked about, like any model, it's not helpful to load in the actual path of SOFR alone. You need to factor in error. So if I apply a 1 standard deviation change over time to this dark blue line, you get the light blue line. And notice how it has a different shape. So you can see this light blue line going up. That's where the rate resets would be if you applied standard deviation to the dark blue line. And we're going to see why that is important when we're looking at how does an option actually work. So let's start building our option. In the label, we have 100 million. So we have that same static $100 million. This time, instead of 3%, we're going to apply a 4% cap rate. So what we're saying here is if we're the buyer of this option, we want to get paid out for our option contract anytime SOFR resets above 4 on one of its observation dates. And currently we're above 4. We're at 532. So let's go and look at the very left-hand side of this table. Look at the 3-month, the 3M. That bar that goes up represents what a payment would be if you took approximately 132 basis points. Where does that come from? It's the difference between 5.32 for SOFR today and 4% for our cap. And if you applied that differential to $100 million for 3 months, you would get a payment of almost $350,000. So you can see that on the other axis on the right. And the other thing that I want to introduce you to is the color of the bar. Notice that some of the bars are just all one color, some are all another. So we have this tan and we have this red. Some of them have both. So we're going to talk about why we have both. So now we're going to pick on the very first one that we see that's all red. Look at the 21M. So this is the 21-month point. Notice something that's important. The dark blue dotted line, which is the SOFR forward curve, it is below 4. It's the first time it actually goes below 4. So if you just looked at the forward itself and you didn't adjust for error, you don't have any of the reset for SOFR above your cap rate. So there should be no payment that particular month. But yet there's a value associated with the cap for that 3-month period of time that's almost $150,000. So why is that? It's because when you apply the error, you have area above the green line to that light blue dotted line. So it's picking up the fact that if given enough time, that blue line that's dark could be inaccurate. And so there's time value associated with this. Time value means that there is no intrinsic value here. None of the forward curve is above that green line, but the time allows there to be more error. And so the option dealer, let's say it's Goldman Sachs, has to account for the fact that there might be a payment, not because of the actual forward curve, but because of the error to the forward curve. So you're assessed a cost for the fact that time could allow SOFR to deviate from the forward curve. So we made that one all red. And what you'll notice is there are periods of time where you have both. So let's go to the 18M, 18-month point. There is still a little bit of forward curve above the green, not much, but some, but quite a bit of deviation now is starting to occur with respect to the error. So each one of these bars actually has a name with respect to derivative finance. They're called caplets. And what we do in order to determine a cap price is we're going to add these caplets up. So for a 1-year cap at 4% on $100 million, we would add up the bars 3M, 6M, 9M, and 12M. And the sum of those is $980,000. And that would be the price for the 1-year cap. If you wanted to do the 2-year cap, you add the next 4, you get $1,510,000. And if you add all of the bars, you get to $2,035,000. And you can do any combination because these are the underlying components of the cap itself, the caplets. So for illustrative purposes, the primary goal of this was to show you how do you use an input, which is the forward curve, the dark blue. How do you adjust that for air, which is the light blue? And then what is the underlying components of a cap and how are they impacted by the cap rate? So a final change for this graph that I want to do is look at the arrows to the left of the interest rates on the left side of this. You'll have the red and a beige arrow. What this is meant to depict is if you move your cap rate up, let's say you move it from 4 to 5, two things are going to happen. One is all of these bars, these caplets, they're going to get shorter because there's going to be less intrinsic value, meaning you're going to have less amount of the forward curve above your cap rate. In fact, if you make it 5, you can see your inflection point is going to be right at about after that 6-month point, there's going to be no intrinsic value anymore. And the area that is above these curves, especially with your airline, is going to be less area. So it's going to make the cash flows less. So these bars get shorter and they're going to get more red because more of the cap's value is going to be coming from time value, from air, than it is from intrinsic value. And then the opposite would be if you move that 4% down to 3, the bars are all going to get bigger, they'll get taller, and they're going to get more beige. This is pretty much, even though I've oversimplified elements of it, if you just knew this as a takeaway for derivative application for interest rate caps, you would know more than the majority of the people on the planet. And hopefully what you can see is it tends to be overcomplicated by misunderstandings. It's not necessarily overcomplicated because option math is difficult. There are elements of option math that can be a little bit challenging at times, but I don't actually deal with option math that much in my day-to-day. Computers can actually, help alleviate that quite a bit. If I had to break out my option math, I would know how to use it, but I don't typically need to. And then I can describe this in a manner that is a lot easier for people to understand what are the moving parts, what's going on, how does an option dealer, like a bank, come up with these option prices. Finally, before we leave this slide, we do tend as a matter of practice at Kensington, when somebody like Nate comes to us and needs to buy an interest rate cap, we usually suggest to Nate, let us just run an auction for you. And what we mean by that is we'll go and get banks ready to bid. We'll have all the terms of the cap that Nate wants to buy in a term sheet. And then at a moment in time, we'll go and collect bids from the dealers and we'll bring the dealer with the lowest price on the phone for Nate so he can verbally accept the contract with whatever that bank was that had the lowest price. The reason we do that is because these caps are pretty much, they're a commodity. There's no credit that has to be underwritten when you're doing a cap. There's no collateral that has to be pledged. All Nate has to do is be prepared to pay for the cap price. Let's say he did the 1 year at $980,000. Just has to be prepared to pay $980,000 within 2 business days of the phone call where he accepted the contract. And he has no further payments that he ever has to make. So why do we bid these? Pretty much everything is the same for any one of the banks that we're working with, except for that light blue dotted line. That volatility line can actually be a little bit different bank to bank. And so you've now seen, why does that make a difference? That light blue line is going to affect the amount of red. So if the line is lower, there's going to be less red. The line is higher, there's going to be more red. So what Nate is looking for Kensington to help him with, besides managing this project, helping with the documentation, getting the banks ready, is he's working with us as an agent because we're saying to him, what we're trying to find is I want to find the bank that wants to put the least amount of profit into the price of the cap. And I want to try to find the bank at the same time that also has the lowest dotted light blue line. That's what the auction process is effectively doing if you look at it visually. Now, this is just interest rate caps. Obviously, there's other hedges. So one of the things that we do to help analyze a variety of different hedges is remember our dark blue dotted line. We have that same dotted line here. That's the SOFR forward curve. But there are other paths of SOFR that could actually occur. We've seen that the forward curves are wrong. So what we tend to do is we come up with different scenarios at Kensington. We say, well, what if SOFR stays unchanged? So that's the straight line. What if SOFR is higher than the forward? So we have a green line. SOFR is 100 bips above the forward curve. What if SOFR forwards are too high? What if the Fed actually cuts more aggressively? Well, we have a yellow line. SOFR is 100 bips below the forward curve. And we run the mathematics on different hedge structures using different paths of SOFR. And it results in a table that kind of looks like this. It's a busy table, but we can compare what if we did an interest rate swap that had certain structure? What if we did 3 different scenarios of caps? What if we did an interest rate collar? How would they perform depending upon the different paths of SOFR? So in this particular table, if you go to the right table, not the left table, and you look at the very top, you'll see 100 basis points below forward for one column header. You'll see forward curve for another column header. These are our 4 different paths. And you can see the cash flow results from the different hedges. Yellow highlights are sort of optimal areas. So notice how in the very top row, where these are interest rate swaps that we're looking at, you have yellow in the label where it says 100 bips above the forward curve or SOFR unchanged. So if you actually knew that SOFR was the forward curve was too low, or that SOFR was going to remain unchanged, an interest rate swap would actually perform better for you from a cash flow point of view than the other 2 scenarios. If you knew that the forward curve was actually going to play out, then the outperformance occurs down with the collar scenarios. Why do we do this? Sometimes people have a view on interest rates. Sometimes they don't believe they have a view, but when we walk them through scenarios like this, they start to develop a view. And it can be helpful because it can help to determine what type of hedge scenario might be optimal for them. There are other constraints besides this, but this is one of the things that we do to help individuals understand what is it that they're trying to accomplish with an interest rate hedge. And then because of that, we have a variety of different structures that we can hedge, or that we can create for hedges. So we have caps, we have swaps, we have collars. We can combine hedge types. So in this case, we've combined elements of a swap with a collar. So mathematically, we can create almost anything. And that's why constraints from the project or constraints from the asset or timeline horizon information like what is your hold period or a view on rates, these things can all come together. And that's really what you're asking somebody to help you do from an advisory side, is manage elements of this process to make it easier on you, run some of the mathematics, help with the documentation. So I have other hedge structures that are here. We can get into these if you want, but ultimately, I think the goal of this particular presentation was to just do this overview for you, starting with what's driving interest rate volatility, getting into how the forward curve can differ from the information that the Fed is sharing with us on a quarterly basis, and then finally putting constraints in to come up with the hedge structures and the hedge prices that we use in our practice.
Awesome. Thanks, Jeff, for coming on. That was really informative. Phil, it was almost a lecture, but a very good, informative lecture. For those that want to find Jeff, he can be reached on LinkedIn, and we will also be publishing this onto our website at theneutralproject.com for those who want to rewatch some points or maybe send it to a friend. But thank you for everyone who attended today, and we'll see you at the next webinar on July 11th. Thanks, Jeff.
Thank you, everybody. Have a great week.